Mode.
Hey everybody, Preston Brent here with our Trader User Group, a weekly roundup. This is for the trading week ending June 8th, 2018. How many of you remember the old movie Wizard of Oz? I may be showing my age, but I remember growing up as a kid watching that movie again and again. Every time it came on every year, I'd sit right in front of the TV, and black and white TV at the time, and then the color, and I'd watch as Dorothy would follow that yellow brick road, always be intimidated by lions, tigers, and bears, and all sorts of potential trouble until she got to the end of the road and she actually met the wizard, wanting to go home. And then she found the wizard was just a little short man behind the curtain. And then after that, she realized it was all a dream. But looking at these markets, it's not a dream. It's kind of like lions, tigers, and bears. There's a lot of things out there, a lot of geopolitical risk. In fact, I've mentioned this before, and I've heard others talk about it as well. But if you imagine knowing the future, last week, before this entire week happened, a week prior, let's say I told you that next week you'd see emerging markets implode. You'd see Brazil fall more than 5 or 7%. You'd see trouble in Turkey, South Africa. You'd see trouble brewing with trade tensions as an upcoming G7 meeting. And you knew that there was big issues in Italy, political elections, and big issues in Spain, or potential big issues in Spain. I'd say, where do you think volatility would go the next week? And where do you think the markets would go? And I would bet that 90% of you would say, well, the markets are probably going to sell off and VIX would go up at least 5, 10%, something like that. But in reality, in this really crazy on-off world with lions, tigers, and bears floating all over the place, the Dow actually moved up 2.8%. The S&P was up about 1.6. Nasdaq hit all-time highs and it was up over 1.2%. It was also up the prior week. And the Russell hit all-time highs and it was up the prior week. And the VIX fell below 13 and it finished the week around 12.18. So it did exactly the opposite of what you would have thought it would have done, knowing the future. So many times, knowing what's going to happen in the future is no guarantee that you could even make money on it. And the markets are used to climbing this wall of worry. But speaking about the markets moving higher, a lot of this trade tariff tensions, uncertainty about the Eurozone, capital outflows from emerging markets as the dollar gets stronger, all of these things. Really, the market right now that is just very strong is the US. And it's all focused on earnings. We're pretty much winding down Q1 earnings. In fact, we're going to start Q2 earnings in about 3 or 4 weeks, which is kind of hard to believe. But Q1 earnings have pretty much wound down. And we're seeing that coming through it year over year. Q1 earnings came in at what, about 23%, 23.3%. Q2 is showing earnings coming in at 19% year over year as bottom line earnings per share. Top line numbers are also growing about 7 or 8%. In fact, the remainder of 2018, we're looking at earnings per share growth of about a little over 22% for Q3 and about 18% for Q4. So full year S&P growth for 2018 is expected right now to come in. We're halfway through the year at 20.6%. Now that was versus last year's 11.5%, almost double. So yes, the markets are moving higher, but we've got very strong earnings to support that growth. And then it's projected to taper off in 2019 and 2020. Okay. But we're seeing both top line and bottom line growth. And yes, there is some risk out there. The lions and the tigers and the bears trying to move us off that yellow brick road. We can see a potential spike in inflation. We're seeing commodity prices rise. We're seeing a possible huge hike in wages, because for the first time, I think, in as long as I can remember, we've got more job openings than there are people to fill them. The FOMC is meeting this coming week, Tuesday and Wednesday. Wednesday, they come out with more than likely an all but assured 25 basis point rate hike. There's a 73% shot that they're going to do a rate hike in September, less than 50-50 for December. And then in 2019 and 2020, everybody wants to know what their dot plot's going to be. The markets have forecasted two more rate hikes this year, one this next Wednesday and one in September. Okay. So let's see how all of this stuff plays out. But we've got clearly a lot of lions, tigers, and bears out there, and can we convert them into good guys to help us out, or will turmoil and tension start up? So right now, let me just kind of give you an overview of my view of the markets, and let's just start first with the S&P. You can see here I've got a daily chart of the S&P 500. All right. And as I mentioned before, earnings are just outstanding this year. The strongest, everything is lining up. Consumer confidence at all-time highs, earnings just blowing the doors off records that go back decades. And I read a statement where Bernanke, the old Fed chair, came out, and I kind of agree with him, believe it or not, where he said we're going to have a Wile E. Coyote moment in either 2019 or 2020. For all of you old fans out there of the Roadrunner cartoon series, which I absolutely loved. My favorite, by the way, was Foghorn Leghorn. And my favorite in that was the Martian and the little chicken who thought he was a chicken hawk. But be that as it may, I believe that the markets here, there are only two things that move prices, really. Price action is based on two things. One, earnings growth, and then two, interest rates. Interest rates, the higher interest rates go, the more treasury and debt securities and dividend type stocks compete with growth stocks for money. And because we've had such low interest rates, there has been no competition. Money's flown into equities. And that's what we've seen. But the higher interest rates go, the more debt is going to compete with equity for money. Right now, the money flow is still going into equities. And as you can see here, once we broke this key level right here, I was telling our members the odds. Once we broke this area here, I said we're going to challenge this area and we're going to stay in this zone for a while. And sure enough, we stayed in this zone for almost 3 weeks. And you can see that pullback brought us right back to touch the opening price for the year. And the minute we bounced off that pullback and cleared and closed right at the 50 EMA right there, I said, okay, this means buyers are going to step in and possibly push it up and take out that pivot point right there. And sure enough, we did. And there was not even a retest. Normally you have about a 58 to 62% chance of a retest. We didn't get it, and away we went. So I said the next stop off point is going to be right at this pivot point right there. And that's kind of where we're headed right now. I don't see anything that's going to slow the markets down from testing this pivot point. Now, that's not to say that, like this area right here, we don't hang up here for a bit, okay? Remember, we got the FOMC next week. We got the ECB coming out with their policy. Now, remember, the Super Mario Draghi is famous for saying we're going to well, they've got in their policy statement now, it's already written that they're going to stop their stimulus of 30 billion bonds a month in September. So this meeting this week, they don't have very many more meetings left, so they're going to be forced, I think, to come out with a statement on how they're going to wind down their balance sheet. Remember, the Feds did that about a year and a half ago when they started talking about winding down their balance sheet. And the markets, while initially got a little bit volatile, they settled in and just kind of accepted that and started moving back higher again. We can expect to see something similar across Europe. So next week could be a little bit volatile for the dollar, for the euro, and for the yen, because remember, Japan on Friday comes out with their monetary policy statement. So we've got central bank galore next week. And as long as they do what the markets are expecting, we should not see too much choppiness. And then, of course, we got the wild card with the G7, because they're going to come out with their policy statement and what they want to do probably the end of this weekend before markets open on Monday. And then early next week, get your popcorn and your beer and get in front of the TV, because it's going to be all hands on deck watching the Singapore Fling, or Singapore Sling, I guess, which is a drink, but it's going to be like an alcoholic toxic brew, because we're going to have Trump and Kim Jong-un there, and I think it's going to be very interesting. And I'm just wondering if they're going to serve hamburgers and Hostess Twinkies for dessert, because I know Trump loves Big Macs, and I'm sure Kim Jong-un looks like he would never turn away a Hostess Twinkie and a Ding Dong. But I think it could be a good meeting. I think Trump will do very well at this, and I think Kim Jong-un needs to do something economically. So that'll help take some pressure off the markets. But there is clearly enough there next week to really jolt the market should things go south. So let's pay attention to it. But I'm just basing my prognostication right now just on the chart action and what I see. Okay. And chart action suggests that we're going to see some more upside next week. It's going to continue. Okay. If we look at the Dow really played off the bottom. Look, look at the Dow futures. We finally went into the green. Here's the Dow right here. And look at this. We're making a series of lower highs or higher highs and higher lows, right? And we blew through the 2018 open price. Now, for our members last Sunday, I said the trade of the week would probably be to go long Dow and short the Russell, because on a relative basis, the Dow's going to outperform. And sure enough, this week it did. Now, why has the Dow been underperforming pretty much for most of this year? Because of the trade tariffs. The Dow has 30 of the largest companies in the Dow, and that tends to make the Dow more susceptible to international trade tariffs than, say, the Russell, which is small cap, and mid cap, which has been on fire. It's been on a charting perspective, it's been the strongest chart. Even though we've seen on a percentage basis the Nasdaq move higher, the Russell has the strongest chart. So looking at the Dow, we're making up time here. We're still, if I really zoom it out, we're still way away from the all-time highs in the Dow, right? If we go back to the E-minis, you can see here the all-time highs in the E-minis are a lot closer, right? Now, in February, from that big drop down, you can see we fell about 350 points, about 12.16%. Okay, so it was an official correction. Our first correction in years, 2017, was a very abnormal year with volatility rarely getting over 10 or 11. So I think we're still on the upside here. Now let's look at the Nasdaq. And in the Nasdaq, you're going to see again a very strong chart, although it was one of the few that finished down on Friday. And let me just move this because we actually made new all-time highs in the Nasdaq this last week, right? There it is right there. We finished, or the high for the week, 72.34.25. And if I were to draw a zone up in this area, in fact, I can put the prior highs right there, right? So we made new highs here by the tune of about 20 Nasdaq points. And if I look at the MACD down here, I do not see really any divergences. So when you don't see a divergence on a Elliott wave 5, that means any pullback, which is typically an A wave down, is usually going to be bought and send the B wave up, more than likely at or above the Elliott wave 5 pivot high. So that's kind of how I'm seeing this right now. Can we pull back a little bit? Yeah, but the momentum is really carrying us up. If you look at the vector of the 50 and the 200 EMA, right? I mean, there's the 50 EMA, there's the 200 EMA. Look at the vector of these things. The 50 EMA is going like that. That's a rocket ship, guys. The vector of the 200 EMA is going like that. That is a rocket ship too. I mean, that's just huge, huge. And if you will recall from the highs in January, the Nasdaq was the only index to make new highs back in early March. The other indexes finished somewhere down here. They could not take out their January highs. Nasdaq did, so that told me that money still wants to come into the market. And any movement down is more buying opportunity than a selling opportunity, right? So the market is not ready yet to just say, okay, we've finished making all-time highs. We're going to chop around a little bit and start making lower highs and lower lows, and then gradually drift into a bear market. We are not ready for that yet. The yield curve is still holding up there. Generally, the yield curve gives us about a 3 months to a 1 year heads up on a potential recession and a bear market. We're nowhere near there yet. So this is kind of the Nasdaq. Now let's look at the Russell, which, as I said earlier, has the strongest chart. And let me just find the Russell on my, where is it? Here we go, right here. So if we look at the Russell, okay, you can see here, and let me just move it up because it's the weekend now. And we look at the daily on the Russell right here. We made new all-time highs in the Russell as well, 1681.20. This colored bar represents my huge resistance zone for an Elliott wave 5, and we've kind of blown through it. So it's going to be a little bit of a chop up in this area, but look at the extension off the lows here. Okay. Now, remember when I told you that the Nasdaq was the only index that made new highs after the January? These were the January highs, and the Russell made up this area here. And the Russell did not come up and make new highs. It came up and tested them, but it didn't make new highs. But we've got this nice vector here of the 50 EMA, of the 200 EMA. Everything, guys, is pointing in this direction. There is, and now in the Russell, as I said, by a stronger chart, you can see the MACD is like that. And longer term, it's flat. So that tells me that any pullback here more than likely is going to be bought, and we're going to see some new all-time highs. Okay. So net, the markets are still in a bullish frame of mind. Now, all of this is given, as I said before, the markets are surrounding themselves across the 5Ts. I've called it the 5T market most of this year. You may have heard me say it many times on these weekly roundups here. You know, and what are the 5Ts? We got the trade tensions, you got the potential tightening of the markets, or the tariffs. You've got the tightening, right, of the financial markets. You've got also what I call the two T's, Trump tweets, which could be related to just about anything, right? And these are where I see the markets, that anything can happen, but just short of the unknown happening, we've got these markets in this bullish action. We need to be careful, as we always do. It's like I said, going down that yellow brick road, right? We're looking to find our way to the promised land. So this is where we're sitting right now. All markets looking strong. Now, if we go look at the Dow Jones transports, the transports are in a very choppy range, but we're holding above the 2018. I'd like to see this thing. And look at this. I mean, we've been in this box here for quite some time. You could probably say it's kind of a bear flag, just a little bit. If I were to connect it like that, it would be kind of an elongated bear flag. The odds favor a break to the upside. Right now in the U.S., for those of you international folks watching, we've run out of truck drivers and trucks because they're shipping so much goods. So things are being held up at the docks, things are being held up at corporations. Our infrastructure sucks. We don't have enough oil to move oil at the rig head or well head to the refineries. So the infrastructure here, hopefully that will be improved. And it's causing some agita in various commodity markets. But from the transport side, I think the odds favor a break to the upside. Okay. That's kind of what I'm looking at short term here from a transport perspective. And that would also be in support of the strong equity markets that we're seeing. Now, if we look at the Vanguard All World Index, as I said, the U.S. is the only pig in the pen with lipstick right now, and we're doing very well. Most other economies are not as strong. Look at the All World Index by Vanguard. It's below the 2018 open price. And in my mind, this looks like it's only getting just a bit worse, right? I mean, if I were to connect the dots here, it's clear what way that channel is going, and maybe we'll come up here and break out, or maybe we'll come up here and then come back down here. And then the big question mark is going to be, will that cause the U.S. markets to roll over, or will the U.S. markets cause everybody else to move higher? Time will tell. Right now, the markets in the U.S., I believe, have more upside to them. Most emerging markets are a little bit weak right now. And if I just show you the emerging markets, we'll take a look at EEM for a second. This looks just like that Vanguard index, right? Now, I don't have the 2018 open price on it, but just understand that we're below the 2018 open price. And if you look at that channel, well, I didn't draw my lines very straight, did I? But you can see, you'd think I've been on Red Bull all morning. I can't draw my lines, but you guys get the idea, right? I mean, that's the direction we're heading in. And this is emerging markets. Why? Well, because you've got a very strong US dollar index. The stronger the dollar, the weaker the emerging markets get, because they're holding a lot of their debt in US dollars. Plus, a side benefit of the repatriation of money to U.S. corporations is they can bring money back to the U.S. and pare down their stock float, reduce their earnings per share. But what that does is it sucks U.S. dollars out of foreign markets, foreign banks, And what that does is cause an exodus of US dollars from foreign markets, which then in turn drives foreign markets down like that. So there's just a lot of moving parts here, a lot of them pointing to more downside action. Now, again, if the ECB comes out next week and talks about stopping the stimulus full tilt boogie on September, October timeframe, and they start to pare down their balance sheet, what's going to be interesting and what I'm going to be watching is what does the euro do? How does the euro react? Not the dollar, but the euro, because the euro is going to cause the dollar to react. Then we're going to look at US German boons, because German bonds or boons, they call them boons. I don't know why, but they do. Um, if those interest rates go up, it's going to force our bonds probably up. It's going to force our dollar down. It's going to be real interesting to see how this plays out. So this is where I'm going to be focusing my attention right now for next week. Let's look at China, the tracking index for China. Well, if you look at this, you'd think, wow, we're down towards the low here. China is having some problems. They've got a ton of debt. And for all these years, the Chinese markets have propped up the U.S. government. The Chinese government has propped up a lot of really bad companies that should not be public. They've propped up a lot of bad corporate debt held by Chinese companies. And now China is slowly starting to unwind that, letting some Chinese companies go bankrupt. Why? Because they want to open up their debt market to foreign investors. But the debt market in China is a lot different than the debt market in the US or in Europe. Remember, the US has the most mature debt market. In the US, corporations have a lot more access to money than, say, corporations in China or in Europe, certainly more so than in China. And the US, they can tap the debt market, they can tap the equity markets, and our debt market is very mature, very experienced. And you would think that that would be the same in Europe, which it is not. In China, it's even worse. So what China has done is to kind of let the government step in and take over the role. But the government's trying to get out of that role and bring more foreign money in. And they're going to have a dickens of a time trying to do that because the way they rate their companies is like Alice in Wonderland compared to the way we rate them. I was reading an article in Barron's where the Chinese rate 30% of their corporate debt as AAA, where in the US, only about 5% of our corporate debt is AAA. And with the size of the economy in China, it should be on parity with the US. So that just shows the rating agency in China, which, by the way, is the Chinese government, is very poor. So, billion-dollar money that's trying to flow over there, big money funds, they're going to watch this. Some of them are going to take a haircut. They got to be very careful as they go into those markets in debt. But look at the Chinese market. I mean, just looking at Asher, which is the bigger companies in China, they're not doing that well. So you got to be really careful here. So there are landmines floating around in that market. Okay. Now, if we come over here and we look at let's say we take a look at the Treasury market. Over in the Treasury market, the bonds, as I've said before, anytime it got up in this area is worth a sell. A short, the odds favored a short coming back down. But once you get down in this area here, I would not be willing to short the bond market. We've got a longer term support area. In fact, it came down and hit my support, maybe just slightly below it. I was calling support at 140 and about 29 ticks. It actually came down to 140 and 5 ticks. That's 5 30 seconds. And I believe it's going to kind of chop around in this area. Remember, the markets have already priced in, the bond markets have already priced in a 25 basis point rate hike. So the bond market's not going to be surprised with a rate hike this next Wednesday. What the bond market is going to be looking at is what is the dot plot for the Feds going out next year and the year after, meaning where they want to take their rates, right? And that's what's going to move the bonds. So it's going to be real interesting to follow the bonds. And at the same time, it's also going to be interesting to follow the U.S. currencies, these currency futures. And if we look at the dollar, you can see the dollar Friday finished up, right? But we're having this little bit of a pullback moment. I think the dollar is in a support area. I think there's still more money to go into the dollar before it makes its final run on 2018 highs. And if we look at the euro, it's going to look just the opposite. The euro is bottoming out, trying to make a little bit of a rebound off these lows here. I had called the euro to come down around this area right here, around 119. I didn't think it would go below that, but it did. It went down all the way down to 115. Now, looking at this Elliott wave pattern, this suggests, everyone, that the euro can come back down to the 110 area. Okay, so this is going to be really interesting. The key on this is going to be, what do the Feds do and say next Wednesday, and what does Super Mario Draghi do and say on Thursday, and then followed up by the Japanese on Friday. I don't care what the chart pattern can be, they can change this in a heartbeat. And I will also guarantee you that Super Mario Draghi is talking with our Power Ranger Powell, who is our Fed chair. They're talking before all these meetings. Trust me, they're on the phones. They're going to know. So in concert, they're trying to support each other. They don't want the euro to get too cheap nor too strong, and I don't think they want the dollar to get too cheap or too strong either against each other. So they're going to be playing these reindeer games. But for us and how we play them, I'm not going to be playing these currencies before these meetings. I want to see how they play out, how the currencies react, and then we can pick a direction after that. If we look at metals, if we look at the gold market right here, the gold market is having a heck of a time trying to get back up above its 2018 open price. You can see here, and this is just to be expected, the gold market it trades its technical patterns extremely well. There is the 2018 open price. And as I draw that line, you can see we started there, we tested it, we came down there, we came down there, we came down there for a few days, we came down there for a few days, and now we're sitting there for a few days, and we're setting here. So this level right about there, just slightly above the 1300, is a huge level for gold. You can see the vector on the 200 EMA is almost flat, okay? And the vector on the 50 EMA is slightly down. So we're either going to get a death cross, and then we're going to come down and take this out and come down to here, which is where I believe the charts favor near term, down in this area here. Okay, and then I'm going to be a happy buyer of gold somewhere down in this area here. I'd love to have it come down here. Then I'll be more of a buyer of gold. I don't see gold getting much up here. If they do, I think there's going to be profit taking and then pushing it back down again. You can see up here I've got the 2016, 17, and 2018 highs. So there's a ton of resistance here. Now, I do believe over the next 2 years, gold is going to be up over 1450 or 1500. But I think we got more downside left. So for our members, there's going to be some really nice plays in gold that we're going to want to do, either in GLD or gold futures. And we're going to play these for the longer term. We're also making a play on silver for the longer term as well. Okay, if we look at silver futures, excuse me, silver futures had this breakout here. It's a little bit stronger than gold, but this is minor. I want to see a little bit of a bigger breakout. To me, unless we can break out of this range up there and this range up there, then silver is just going to chop around for another 6 months to a year. But I want to start to accumulate a position around this area here, and I'll be willing to accumulate a little bit more if silver falls down just a little bit more. That's what I'm looking for in the silver market. Energy, it's all about OPEC now on June 22nd. You can see energy came down and hit my support pattern here, or my support area. As you can see, that colored bar right there, it came down and hit it perfectly. That was on a swing time frame pattern here at the 2-hour chart. You can see that was my support area, came down and formed an Elliott wave 5. We came down and did a retest. We're up. We may even come down and do another retest. We're trying to capture this upsloping trend line here. I think near term, oil is probably going to stay north of 60 and south of, let's say, 67, in this range. I don't think oil is going to move too much prior to OPEC. Remember, the markets have priced in the Saudis are going to add about another 500,000 to 1 million barrels of oil a day. When they came out with that statement, the WTI was up here around 72, and when they came out with the statement, you see a lot of this is now factored in. A big part of this move in oil right now reflects that comment from up to this level down here of them taking about 1 million barrels per day of oil out of the markets, right? So we're sitting in this level here now. If they in fact do that, Oil can move a little bit lower, like I said, down to the 60 range. However, we've got Venezuela and Iran with issues where if the tariffs start to kick in with Iran and Venezuela starts having trouble getting their oil to market, global markets, then that's going to put some downward pressure on oil as well. I'm sorry, upward pressure on oil. So there's these two competing forces. So when you put these together in one overall thing, that's why I believe oil is probably going to stay, somewhere in the 60 to 70 range near term, over the summer months. Unless something really unusual happens, I think we're going to be in this kind of range. It will be choppy, and you'll see day traders and swing traders, being more willing buyers in the lower 60s and more willing sellers in the higher 60s, at least for now, okay, until we get clarity on the OPEC move. Um, and then in agriculture, we've played corn, and you can see this big move from when we were playing corn here down to this area here. I suspect you can see the 2018 open and the 2018 low. We've given up a lot of the 2018 high. You can see the various high and low levels here. That's on a 2-hour chart. If I were to blow it up to a weekly, you can see it just a little bit better where we're testing the 200 EMA. I think their oil. I think corn can move a little bit lower. It's probably going to find a little bit of a support area here until we get more clarity around the harvest in corn. All right, everybody, that's kind of where we're sitting right now. Members, I will see you this Sunday night. We got some really interesting trades that we got on, things that we're playing. If you're not a member, I highly encourage you to come in for our Option Masters. Man, oh man, what a fun time that is. We are just kicking it. We've got a number of videos out there. We're adding more. If you're not in that group and you want to definitely take your option knowledge up to a master's level, this is what I highly recommend for you. All right, everybody, have a great weekend. Members, I'll see you this Sunday night. Take care, folks. Ciao now.